Okay, guys, let's start. It's already 4:30. And this video will be recorded and then it can be shared to other people that were not able to attend this webinar today. We understand that it's Monday. Everybody works at 4:30, most of them. So it was a bit difficult for them to enter this time. But for the people that are here, I would like to have an interactive conversation with you guys and discuss about some things about what is going on in the financial markets. So today we are going to discuss a bit about the Federal Reserve rate hike of 2023, the latest that we had in May, few days ago, and whether this will be the last one. Depending on the news we had also on Friday, the job market is still solid. We had more jobs than expected. A few words about me, who I am. My name is Tiliana. I'm the head of investments and market research in Pure FinTech. So I have a degree in business management and finance, accounting, and I'm a member of the Certified Chartered Accountants previously. I also worked in an audit firm, KPMG, for 4.5 years. And I'm also an investor. I personally invest in the financial markets, in stocks and crypto. Why am I saying that I'm also investing? To show that I'm myself involved in the financial markets. I do it firstly because I enjoy it and then because it's my occupation. Okay, let's see what we're going to discuss about today. We're going to explain what is FED, the Federal Reserve rate, and why does it matter? Why do we care about the interest rates that the Federal Reserve sets? The Federal Reserve is the Central Bank of America. The current state of the economy, where we are today. Hello, May. Thank you for joining. And the Fed stance on this current state of the economy, how the Fed and the Federal Reserve rates affect the current state of the economy. Also, we're going to discuss about some factors that could influence the Fed's decision. So what makes them decide if they're going to increase the interest rates or decrease them or stable them? Possible scenarios for the rest of 2023 on what can happen in the economy and in the financial markets. And we're going to also conclude on those things. First thing first, what is the Fed rate and why does it matter? When we say Fed rate, does anyone from here understand what we're talking about? In simple words, what is the Fed rate? Do you have a basic understanding?
No, it's like federal rates.
Yes. The rates that the Central Bank of America, or in our case in Europe, the European Central Bank, they have benchmark rates with which the other banks can lend to, the central bank can lend to commercial banks and the commercial banks can lend to people. So the Federal Reserve role is to set the interest rates for the economy. The Federal Reserve is the central bank of the United States. As we said, the Central Bank of Europe is the European Central Bank. I want to mention here that when the Federal Reserve last week increased interest rates by 25 basis points, also the European Central Bank increased interest rates by 25 basis points. So, and it is responsible for implementing monetary policy to promote economic growth and stability. One of the key tools that the Federal Reserve uses to implement this monetary policy is the federal funds rate, which is the interest rate that banks charge each other for overnight loans. For example, if a person who lives in America will go now to the bank and ask for a loan, he will pay a much higher interest rate than he would have paid 2 years ago when it was close to zero. When we were in the pandemic, the banks were decreasing interest rates. We had very low interest rates in order for people to be able to get loans and circulate more money in the economy. But now they're doing the opposite. They're raising interest rates, so people will find it more expensive to lend money from the banks. And then we want to have less money circulating in the economy. Why? Because we want to decrease inflation. When there are more money floating in the markets, that means that people are able to buy more things, there is more demand, there is less supply, and this is what creates inflation. What is the impact of interest rates in the economy? Higher interest rates generally lead to lower inflation for the reason that I have just explained, and slower economic growth, but can also make borrowing more expensive for consumers and for businesses. Lower interest rates, the interest rates that we had during the pandemic, can stimulate economic growth and borrowing, but may lead to higher inflation. And that's what led us to the situation that we have today with so much high inflation. Anyone has a question? You can ask anything you want. Yes, Pandelis. Pandelis, you raised your hand. Maybe you have a question. Ah, okay, no raised hand. Okay. If you don't have any questions, we will continue with the next slide. Now we will see the current state of the economy, where we are today in terms of financial situation in the European and in the US markets, and the Fed stance. Recent economic indicators review recent data on gross domestic product growth. This is what shows us where our economy stands, the gross domestic product, the employment and the inflation. On Friday, we had the non-farm payroll results and the unemployment results. I am going to find it from the Forex Factory in order to explain you exactly what happened on this Friday with numbers. Okay, so in the previous Friday, as I said before, we had the non-farm payroll change. What is the non-farm payroll? Anyone knows? It's it's one of the most important indicators of inflation. It is the change in the number of unemployment, sorry, not inflation, but it leads to inflation. It is the change in the number of employed people during the previous month, excluding the farming industry. The analysts have expected that in the previous month, we will have 181,000 new jobs in the American market. Instead of 181,000, we actually got 253,000. So way more than analysts expected. This is the number of people employed during the previous month. That means that the employment market is still solid. In order to reduce inflation, we need to see that the unemployment has risen. But in this case, this is not happening. We see that much more jobs have been added to the economy than the jobs that were expected. And also, we have seen the unemployment rate for the previous month. The analysts were expecting a 3.6% unemployment rate, but the actual number was 3.4%. Again, lower than the estimates and lower than the analysts' expectations. When the Federal Reserve sees that the economy is going well, that the unemployment is decreasing instead of increasing, they were more likely to increase interest rates, not to lower them. So we will discuss a bit the recent interest rate hikes as we have seen the previous week and the reasoning behind them. Based on what I have said until now, anyone maybe can guess the reasoning behind the increase of interest rates from the Federal Reserve. Why do they increase the interest rates? You can guess. So the Federal Reserve is increasing interest rate in order to make borrowing more expensive and mitigate the inflation. Moving on, let's see some factors that could influence the Federal Reserve decision. Let's see first some economic factors. First, they review the key economic indicators that the Fed uses to make decisions about interest rates, including inflation, unemployment, and gross domestic product growth. Technically, when we have two periods of negative gross domestic product, we can say that we're in a recession. Recent changes in these indicators and how they could impact the Fed's decision. What are the recent changes into these indicators based on what we have seen on Friday? Is the employment market going well based on what the numbers that we have seen? The jobs market. Pandeli said higher interest, correct, very correct. From what they have seen from the latest results of the unemployment rate, they will most probably want to increase interest rates even more because we see that the job market is still going good, it's still solid. We cannot see things slowing down in the job market. Friday's jobs report, so here we can see also April's jobs report, that the one we have seen on Friday, shocks with the 253,000 jobs created, and we have also seen unemployment fall. Friday's jobs report also came after the Federal Reserve voted this week to raise the benchmark interest rate by another 0.25%. Bringing the Fed funds rate above 5% for the first time since September 2007. So currently, the benchmark interest rate is at 5.25%, a percentage that we haven't seen in the markets since September 2007. That means that it's even more expensive for people to borrow money than it was so many years ago. Even in terms of, okay, let's say someone wants to buy a house right now, and they need to loan money from the bank in order to buy this house. They will pay around 5% interest rate on their mortgage. That means that they will have more expenses to cover. Let's say that they want to buy a house for 250,000. Okay, they need to pay 12,500 euros per year just for interest, not to repay the capital amount. So people who are financially literate, they will think that, okay, maybe this is not the right time for me to buy a house if I have to pay this much money just for the interest rate without even repaying my capital amount. and less people will borrow money from the banks. In raising rates on Wednesday, the Fed Chair Jerome Powell is the chair of the Federal Reserve, said that the labor market remains very tight, and he said that even before seeing the results on Friday, but noted that there are some signs that supply and demand in the labor market are coming back into better balance. So maybe we will see this to happen in the future, maybe in the future months, pointing to an uptick in participation among prime age workers 25 to 57 years old, as well as moderating wage gains and drop in job openings. Also, we have geopolitical and global economic trends, which is one of the factors that could influence the Fed's decision. For example, trade tensions, international monetary policy, or other global economic risks. Guys, can you see my presentation? My PowerPoint. Someone write me on the chat if you can see my presentation.
Yes, we can see it.
Okay, thank you. Do you have any questions up to now? You can ask anything related to the financial markets, anything related to the Fed, to the rates, and for the economy. Maybe there is an investment that you are considering and you want to ask a second opinion. Okay, now let's move on. Fed increases rates a quarter point and signals a potential end of hikes. This is what we have seen, what they said in their previous meeting, that this will be the last rate hike, though this may not be the case. The Federal Reserve approved its 10th interest rates increase in just a little over a year and dropped a tentative hint that the current tightening cycle is at an end. It will not be an end unless we see the results that they want to see. What they want to see inflation falling, and they want to see the job market to have way more the unemployment rate to rise a bit in order to see inflation slowing down. The widely expected decision, which takes the Fed funds rate to a target range of 5% to 5.25%. The post-meeting statement omitted a sentence present in the central bank's March comments, saying that the committee anticipates that some additional policy firming may be appropriate for the Fed to achieve its 2% inflation goal. As we can see here, the inflation goal of Federal Reserve and the European Central Bank for every year is 2%. So they will continue implementing their policies until we see a 2% inflation goal. As we can see here, the US labor market remains resilient. This is the total non-farm payroll in thousands until April 23, and the unemployment rate. What is the Fed raising interest rates means for investors? Why do we care about the Fed raising interest rates? Because by raising interest rates, the Fed wants to make borrowing more expensive, and then rising interest rates would encourage people to save more money. All we hear in the last couple of months is that things are not going well in the economy. We're going into a recession, so people are more encouraged to save money. Less money circulating in the economy means that slower economic growth will happen and will decrease inflation. Now let's see some possible scenarios for the rest of 2023. Do you have any questions before we go through the possible scenarios? If you cannot talk, you can write me also in chat. Vandelis is asking, do you have any specific areas to recommend for investment? For example, stocks or cryptocurrencies? This is depends on your investing time horizon. For how are you a long-term investor? Are you a short-term investor? You have to be more specific, please. And it also depends on your risk appetite. If you're a person that you don't want to, you're not too risky, you will not invest in cryptocurrencies if you don't like risk, for example. Because cryptocurrencies is a risky asset. The fact that in Europe, depositors have withdrawn more than 39 billion, I suppose, euros, since it's in Europe, it affects the banks because banks have no more liquidity currently. That's why they close one after the other. Let's go to the first scenario, that the Fed maintains its current interest rate policy. The Fed decides to keep the interest rate at its current level for the rest of 2023. This could lead to continued economic growth as businesses and consumers have access to more affordable credit. The other scenario is that the Fed increases interest rates, what the Fed is currently doing. Now let's see the federal funds effective rates from the statistics label, economic data. And we have seen that it's increasing. We don't have 2022. Depending on the economic condition, on the financial condition in the markets, they are increasing and decreasing interest rates to achieve 2% inflation goal. Another scenario that we can discuss is that the Fed engages in quantitative easing. The Fed decides to engage in quantitative easing, which involves buying government bonds to increase the money supply and stimulate economic growth. This will happen after we were able to get inflation into the level of 2%. And when we're going to go into a recession, this is a tool the Federal Reserve that they can use afterwards. This could lead to increased investment in stock market and other assets as investors look for higher returns. However, it could also lead to inflation. What happened in this case, as the increased money supply could lead to higher prices for goods and services. Now, let's discuss a bit about how the higher rates added to banking issues. This is why we were seeing these regional banks closing the one after the other. What started this was the higher interest rates. While higher interest rates have compounded the banking problem, Fed officials instead insist their focus squarely on inflation. Recent data points have indicated a softening in price increases through sticky items such as housing costs, as we have seen it's more expensive to buy a house. Medical care have remained higher, while prices that tend to change a lot, such as food and energy, actually have decelerated according to Atlanta Fed calculations. Markets are anticipating that slower growth and the possibility of a recession will force the Fed to cut rates later in the year, or maybe next year. This is just a timeline of how the banking crisis has started. With Silvergate, Capital Corp says it wind down operations and voluntarily liquidate the Silicon Valley Bank. The HSBC then acquired the UK subsidiary of the Silicon Valley Bank for only £1. Then on March 2017, we have seen the Silicon Valley Bank Financial Group to file for Chapter 11 bankruptcy protection. And on March 19, USB agrees to buy Credit Suisse for 3 billion Swiss francs in stock and agrees to assume up to 5 billion francs in losses. And this is how the Silicon Valley Bank model failed. Anyone has a question? Let's briefly see what actually happened to Silicon Valley Bank and what led to this bank fail. The most common cause of bank failure occurs when the value of the bank's asset falls below the market value of the bank's liabilities, which are the bank's obligation to creditors and depositors. The bank was shut down after its investment greatly decreased in value. The bonds actually decreased in value. And why the bonds decreased in value? Because the interest rates are so high, and its depositors withdrew large amount of money, among other factors. Why did the SVB lose money on bonds? The bonds lost value because the Federal Reserve has been raising interest rates, and as interest rates go up, bond values go down. As more the Silicon Valley Bank's clients took their money out, it had to sell bonds in order to repay the other clients, and they were selling these bonds at loss. And it wasn't enough to keep the bank afloat, so numerous banks, though, own bonds that have lost value as well. Now, let's see a bit what will happen next based on history. No one knows exactly what will happen next in the financial markets. According to the Fed meeting on March, the FOMC said we'll keep raising interest rates despite the banking crisis. And as they intended to raise interest rates one more time in May, this is what we have seen, but they said that after May, they will pause rates. We will see in the future months what will actually happen. When something big breaks, like the debt bubble, for example, in the US, people lose their jobs and unemployment goes to from 5 to 10%. Now is currently at 3%. We have very low unemployment, 3.4%. So causing the Fed to start cutting rates, pushing us into a recession in late 2023 or early 2024. The markets will finally find the bottom as inflation goes near to 2% interest rate, and interest rates also 2%, and it will be once in a decade opportunity for people if they want to buy stocks, real estate, crypto, or other investments in bargain prices before the bull market begins in 2024 or a bit afterwards. Yes, Pandelis, it's true that the Silicon Valley Bank had the deposits of many startup companies. Okay, so I'm listening to questions. You can also write me suggestions about our next webinar if you want to discuss about something specific. If someone is writing. Training on investing in stocks. We have several videos on YouTube about investing. We also upload, I don't know if you follow us on Instagram, Pandelis, I think you do. We upload weekly videos about investing, but we'll continue to do that. We'll write more articles and try to educate our clients and people who want to learn how to start investing. Okay, guys, thank you very much.
Thank you, Styliana.
Thank you, and stay tuned because we're going to have more webinars and we're going to get educated together and learn about the news. And thank you for being here today.